friends, this is Araceli, Transition Wealth Advisor. Today I'm here with a good friend of mine, Cherryl Small. Cherryl is a mortgage professional working with Matrix Mortgage Global, a full-service mortgage company located in the GTA who funds mortgages all across Canada, and they specialize in private funding and the alternative market. All her information is below. Today's subject is credit and credit score. So you're going to be learning, number 1, what is credit and what is a credit report? Number 2, credit ranges and the reasons your score can drop. And number 3, how to improve your credit score. And here is Cherryl.
Thank you, Araceli, for having me. This is a very important topic, and I'm happy to speak on it. Let's start with, what is credit? Credit is future payment for goods and services, and the average Canadian is carrying enormous debt with a lot of credit. It's very important that people recognize just how important good credit is, understanding the impact of your financial health as it relates to your credit score. Your credit is very important for things like renting an apartment, getting a mortgage, buying a car, or any other goods and service. A poor score usually results in higher rates for any of these things. What is a credit report? A credit report is a report that contains all of your credit-related personal information over a number of years, like a report card. Once you open up your credit or your trade line, every payment made or payment missed will be recorded. It will show how long you've had your credit, what the credit is, outstanding balances, how much credit you started with, missed payments, late payments, canceled accounts, inquiries made on your credit, bankruptcies, proposals, liens, judgments, collections, etc. Most credit is reported to the Bureau. Sometimes it's not, but let's assume it will be reported. Whatever is reported to the Bureau will remain on the Bureau for an average of 6 years. Sometimes it will remove in 3 years and as long as 14 years. We have 2 bureaus in Canada, Equifax and TransUnion, and they sometimes report differently. So sometimes you'll notice a little bit difference in the rates in the scores from both of them. Let's look at your scores. It's a 3-digit score from 300 to 900. Generally speaking, the higher your score, the better the higher your score, the better your credit worthiness is. The lower the score, more of a risk that you are seen as by the lender. Here's how your credit score will appear to most lenders. 700 to 900 is outstanding. 725 to 759, very good. 660 to 724, good. 560 to 659, average. 300 to 559, poor. Generally speaking, like I said, if you have a score that's higher, that's better. If you have a score of 650 and above, you're generally looked at in very good standing and would most likely be approved by most of the lenders. Financial delinquencies, bankruptcies, consumer proposal, accounts in collection, activating or canceling too many accounts within a short period of time, errors on your credit report that go undisputed, recent hard inquiries performed by lenders and other organizations when considering you for new credit, all of those factors can slow or damage your credit score. And unfortunately, when it drops, it takes a long time to repair and requires serious attention to get it back to the point where lenders no longer consider you a financial risk. So let's look at how you can improve your score. To build your credit, first you have to have a credit. Don't shy away from having credit, so apply for credit and start using it responsibly. Start small, don't apply for too much credit all at once. So now that you have established credit, be responsible with your credit. Pay on time, don't pay late, not even a day late. It's also recommended that you pay twice a month if you can, because if you can pay before the end of the month, before your billing cycle, that usually will help you. Try to keep your balances low at the end of your billing cycle. Don't max out your credit. It's been said that utilization should be around 30%, although I've heard that you can even keep it lower than 30%, would even be good. Don't apply for too much credit in a short space of time. That makes it look like you're sort of desperate and you're really seeking credit. It shows them that you may be in trouble. And it also has many hard hits against your credit if you're pulling too much credit at once. Keep it to 3 trade lines of varying credit and moderate balances. That will be best. Multiple credit cards, all maxed out, is no good. Lenders can see when you've been asking for credit too much. It looks like you're going around seeking credit. They can see when you've been denied for things like a car loan, mortgages, credit cards, or personal loans. Be on top of your credit. Look at your account often. Take note of what is going through your account. Review your report for any errors. Contact Equifax and TransUnion immediately if you find errors. Errors can affect your score. I recommend that you also ask for your free credit report yearly from both Equifax and TransUnion. Why? Because you can't fix what you don't know. At least if you know those errors are there, or if there's any disputes, you can work on it. You can also pay for monthly monitoring from Equifax. You can also apply for a secure credit card. This is something that I recommend that you do so that you can start to build your credit. And if you keep your credit strong, your credit is golden. I recommend that you keep it strong, and so that you will have no problems financially in the future. Take care.
If you have any questions about this video or need help to start a new financial plan, please contact me and book a free discovery session. All my information is below. Please remember to subscribe, share, and like. Until next time, this is Araceli, Transition Wealth Advisor.